You're listening to the Alan Gray podcast. I'm Horatia Naidu-McCarthy, a manager in Alan Gray's institutional clients team and your host for this episode. It's been almost 2 years since we last spoke about frontier markets on this podcast. Since then, the world has not stood still. The so-called Great Election Year of 2024 has come and gone. Political regimes have shifted, energy and fuel crises have reverberated across economies, and geopolitical tensions feel increasingly difficult to ignore. Against this backdrop, markets have been grappling with the convergence of pressure points: persistent conflict, energy insecurity, and volatile inflation. Historically, frontier and smaller emerging markets have found themselves right at the sharp edge of these risk-off episodes. Today's conversation centers on a familiar but uncomfortable idea that fear can cause markets to overstate risks in frontier and emerging markets, pricing assets well below what company fundamentals might justify. Joining me to unpack this are Alan Gray portfolio managers Rory Katiska-Jacobson and Varshan Maharaj. So Rory and Varshan, your fundamental research often takes you well beyond the spreadsheets and into parts of the world many of us only read about. What's been your most amusing or unexpected experience from a site visit in a frontier or emerging market? And I'll start with you, Rory.
Thanks, Horatia. You make things sound a lot scarier than they are. So hopefully the conversation kind of demonstrates that there's opportunity more than risk. But I think one of the greatest opportunities that we have actually as investors is we get to travel to a number of countries that we otherwise wouldn't. And you get exposed to a variety of different cultures and people. And broadly speaking, I mean, you're almost always pleasantly surprised by how friendly and warm and welcoming people are. A couple of years ago, I was in Hanoi, which is in northern Vietnam, with one of my colleagues. And we were looking for a restaurant that might be frequented by the locals. And so we went to Old Town Hanoi and we came across what looked like a very busy restaurant, lots of plastic chairs and tables outside. Also, insider tip, if you're looking for a good place to eat almost anywhere in most emerging markets, if you see a queue of locals outside, it's almost always a very good restaurant. But we got a table outside. We were really enjoying the meal. And then at one point in time, I needed to go to the bathroom. And so they had a very small kind of inside area where people were also seated. But then once you went through that, you quite quickly realized actually the restaurant was someone's house. And so you went through another interleading room where there was a little old lady sitting on the couch watching TV. And then you go to the bathroom, which is actually just the guest toilet in the house. And it doubles up as a storage cabinet for all of their cleaning equipment and mops and supplies. And so I thought that was quite interesting. And I guess indicative of how people can be quite entrepreneurial as well. And then the other maybe kind of also interesting story for me is when I was in Pakistan, security is quite front of mind for the country. And so almost every office or commercial building or hotel that you enter, there's quite a heavy level of security. There's metal detectors everywhere. But also if you enter with a car, they have these metal rods it's almost like a traditional dowsing stick, which people used to use to find water. But instead they have this long rod. And on the end, there's allegedly an electrical device that can detect bombs. Now, it's been proven through multiple independent studies that this is a completely fake device. It has no impact or effect whatsoever, yet its use is still widespread throughout Pakistan. So every time you enter a building, you go through this little dance where the person will walk around your car with their dowsing stick checking for a bomb, even though it's completely ineffective.
So we have a story of you potentially crashing someone's Sunday lunch and then you potentially...
Well, they invited me and then they charged me. So I think it was a...
and Varshan, you?
I agree with what Rory said. Every country is so unique and interesting in its own right. So it's hard to choose. But the country that I went with is Cambodia. The local currency it's $1 equals 4,000 Cambodian riel. So within a few minutes of arriving in Cambodia, I instantly felt like a billionaire in local currency. And while I was there, I decided to attend a boxing match. I actually got allocated ringside seats, so I got to be on Cambodian TV while I was there, which was also quite cool.
So, I mean, to bring it back to today's podcast, I think we last chatted about opportunities in frontier markets in episode 18 in 2024. Now, since then, the Allan Gray Frontier Markets Equity Fund has grown to almost $1.4 billion. And it's actually one of the best performing frontier funds globally over the last 5 years. So let's dive right into how the both of you are thinking about that investment universe. So Rory, you once described the Frontier Fund as your first child, so I'm going to start with you. The broader environment has been especially noisy. Notably, we've seen conflict, energy shocks, and inflation flaring up globally. What are the main channels to which these risks actually transmit into frontier and emerging market economies? And where do you think markets sometimes exaggerate the impact?
So yes, it is my first child. So I've been really fortunate enough to be involved with the Frontier Fund since inception. And so to your question, I think what's really interesting for me around frontier markets is almost always the conversation immediately goes to risk. And people completely, in my mind, overestimate the risk instead of actually asking what is probably the more appropriate question is, given the risks, are you being adequately compensated for taking those risks? And or to what degree is the market inefficiently pricing some of those risks? And so there's a number of ways to kind of think about it. But for me, I think the best analogy perhaps is if you imagined you had a coin and it was perfectly equally balanced, you flipped it heads or tails, and on average, it's going to land on heads or tails 50% of the time. Now, the normal kind of odds on that would be 50-50. So for every dollar I bet, I get $1 back if it lands on heads, or I lose my dollar if it lands on tails. In Frontier, what often happens is because people are so disproportionately focused on those risks, you get completely inefficient pricing. So in the same scenario now, if I was betting on heads, I'm going to get $3 back for every time I risk $1. Now, of course, if you had $100 to play with, you don't bet all $100 on heads landing on the first coin toss because it can land on tails and you could lose your money. But if you bet 100 times and you bet $1 each time, roughly 50% of the time, maybe it's 51, maybe it's 52, maybe it's 48 or 49, you're going to land on heads. And every time it does, you're going to get back $3 versus every time it lands on tails, you're going to lose your dollar. But on aggregate, you're going to do very well and you're kind of compensated to take that risk every time. And I think that's a little bit like frontier investing, where yes, there are these risks and there are these things you worry about, but actually I think you're being more than compensated for taking those risks.
And Varshan?
Yes, I agree with Rory. I think people focus on the negative news and often they extrapolate what's currently happening far into the future. And the end result is you get markets and stocks trading at very low valuations. For example, Pakistan a few years ago, the entire index was trading at between 3 and 4 times earnings, which is a very low level of valuation and attractive prices. And investors that bought in at those levels have made handsome returns. And that's not sort of out of the blue example. This is something that happens continuously across the board in frontier markets.
There's numerous studies that show the strong correlation between starting valuations and future returns. But you mentioned something about, it being sort of noisy geopolitically. Do you view the current environment as another difficult but ultimately cyclical phase for frontier and emerging markets? Or are there elements here that could actually represent a more structural shift for long-term investors?
Every day we read the sort of doomsday headlines and so on. And it always reminds me of something that someone once said to me, is that it's not wise to bet on the end of the world since it only happens once. And to answer your question on cyclical versus structural, so the way I think about structural risk is it means it's a company or an industry where demand has collapsed to such a great extent or supply has increased to such a great extent that it's not going to recover in the next 5 or 10 years. Or another example would be a company that's been managed in a very corrupt or negligent manner. And all of those things do happen, but they're relatively rare. I think the vast majority of situations and scenarios are cyclical. And when I look across the vast pool of cyclical businesses, over the medium to long term, the vast majority of them are going to be poor shares to own if you look at the distribution of returns historically. So for me, the goal of analysis is trying to work out which companies are going to grow their earnings over the forecast horizon. And from that set of companies, which ones are trading below what we think they are worth, and which ones have an asymmetrical return profile. So what I mean by that is there's more upside risk than downside risk. And when I look at the fundamentals across the frontier universe, there's so many countries with young, growing populations that are still at a relatively low level of wealth and are going to grow their consumption over time. And that's a very fertile ground for advantaged businesses with good management teams. And perhaps also when I look at valuations, there's many good companies in the frontier universe that trade on low multiples versus what we think they should be trading on, and low multiples versus developed markets. So that also indicates to me that we're in an opportunity-rich environment. And the last thing I would touch on perhaps is price. So when we look at the indices for frontier and emerging markets, they've held up relatively well in absolute and relative terms against developed markets. And they have bottomed and seem to be in the early stages of uptrends. So even though Frontier has performed well over the last 1, 2, and 5 years, I think that we have a very exciting period ahead of us.
To kind of reiterate or emphasize some of the points, I think actually the greater the perceived risk, the greater the geopolitical tension, the more negative the sentiment, the greater the opportunity is for people willing to do the fundamental research and almost go in the opposite direction of the crowds and the masses. So one great example, I think, is if you took what happened with Russia and Ukraine. So we owned a bank in Kazakhstan called Halyk Bank. So coming out of COVID, kind of end of 2021, Halyk Bank was trading on roughly $15, $16 per share. They just reported 2021 earnings of around $3.60. So trading on roughly, 4.5, 5 times earnings. Then late February 2022, Russia invades Ukraine. Obviously, the whole of Russia sells off. The whole of Ukraine sells off. Russia becomes de facto uninvestable. But then the entire region sells off as well. So you have shares in Poland falling 30, 40%. You have shares in Georgia falling 30, 40%. And similarly, you have shares in Kazakhstan, where Halyk is based, falling 30, 40%. So at the bottom, the share price fell, just under $7 per share. But almost throughout kind of most of 2022, you could have bought Halyk for somewhere between $8 or $9 up to $11 a share. On average, let's say $10 a share. And so we did our research, we looked at it and we said, look, the region's probably going to be quite badly impacted by this war and this disruption to not just those two economies directly involved in the war, but all of the surrounding economies. But here is a bank that's very well capitalized. It's got a very dominant market share in its local market. And the long-term opportunity, we think, is still intact for them to kind of grow the formalization of financial services in Kazakhstan. And so, we almost doubled our investment in the subsequent 6 months. Actually, what happened in practice is rather than earnings contracting, when they reported their 2022 results in early 2023, earnings had grown to just over $4.40. So roughly a 20% earnings growth in 1 year. And part of that is actually a number of the surrounding regions inadvertently benefited from the disruption of the war because you have a lot of regional trade being redirected through economies that aren't impacted by the war. And you have a number of people that are disrupted either from Ukraine or Russia kind of semigrating to these neighboring countries to escape the war. And they've continued to compound and grow earnings since then. And because they were so well capitalized, they've actually been able to pay dividends as well. So they paid a dividend of roughly $2.20 at the end of 2022. End of 2023, they pay a dividend of $2.23. End of 2024, including an interim dividend, they pay a dividend of just under $3 a share. And now for the most recent financial year, including the interim dividend, they've declared a dividend effectively of $4 per share with your final dividend to be received in May this year. So if you add that up, you're getting back dividends of around $11.40 on an investment you would have made less than 4 years ago at roughly $10 a share. 100% of your money back in less than 4 years. You still own that share today, which, by the way, is trading at $35 a share now.
I mean, that's a great story. You certainly don't want to profit from war, but it's a great story of doing the fundamental research and it mattering through the uncertainty, through the noise. You touched on something that I find rather fascinating. I think a lot of us, when we think about our investments, we think about the movement in the price, and we sort of anchor to that movement in the price. But a lot of opportunities that you're finding in frontier and emerging markets, a lot of your returns actually coming from something like dividends, for example. How do you think about this when you're doing your research? And I think I'll extend it even further and say, you've got your frontier and emerging market opportunities. If you had to contrast them to how you think about stocks in more developed markets, you have to think about them very differently, by virtue of where they operate.
Yeah, I mean, that's a great question. So broadly speaking, when we're looking at frontier companies, we try our best to analyze these businesses and to get a good understanding of what is the true value of this business if you had to own it over the long term. And I mean truly long term, so we're talking 10 years plus. But our investment horizon in practice is probably 5 years plus. And so we would evaluate this business and we would say, look, what is the quality of this business? How capital intensive is it? How big are their moats? How defensive is it? What are the expectations for growth? And so what do we think is a reasonable multiple to pay for that business? Now, regardless of that, we are also cognizant of the fact that for whatever reason, small emerging and frontier markets are most likely to trade at a significant discount to their equivalent developed market peers. Now, we can have a completely separate debate about whether that's rational or irrational. But when we are investing in these companies, one of the things we don't do is say, let's make our investment case hinge on the fact that this business has to re-rate to what we think is the right multiple, as opposed to actually let's just assume it stays on the current multiple that the market is putting on it. And so then we say, well, what can the underlying business do? And so you spoke to dividends. So one of the ways you can get a return as a shareholder is through the annual dividends. And then the other way you can get returns is through earnings growth and growth in that dividends. And so broadly speaking, if we found a business that, let's say, today was trading on 6 times earnings, and we thought actually it was worth 15 or 16 or 17 times earnings, if it does re-rate to that multiple, that's fantastic. But actually, we're also just equally happy to buy that business at 6 times earnings and own it for 5 or 6 or 10 years and have those earnings compound every year at 10 or 15% in US dollars. And at the same time, you're earning probably a dividend yield, if it's on 6 times earnings, north of 10%. If in 10 years you sell it for 6 times earnings, you've probably made a return of 15 to 20% in US dollars. If for whatever reason it does re-rate, then your return is even better. But we don't kind of hinge our investment on the market suddenly broadly re-rating a number of these stocks.
Okay, so Varshan, looking back, are there any examples in your mind where liquidity rather than fundamentals has clearly been the dominant driver of price moves?
Horatia, there's been 2 examples that stick out in my mind where the story has gotten ahead of the fundamentals. The first example is VinFast, which is a Vietnamese electric vehicle manufacturer, which listed in 2023 at $10 per share, and within a month had run up to $93 per share, which put it at a market capitalization that was greater than Ford and many other established vehicle manufacturers, despite the fact that VinFast was a fraction of their size, which we found very odd at the time. And currently it sits at about $4 per share. So it's dropped in the order of 90% from its peak. And a second example would be Vinpearl, which is a hotel owner and operator in Vietnam. It's an interesting contrast for Southern Sun Hotels, which we own in our South African funds. So if I were to compare Vinpearl to Southern Sun, they have almost exactly the same number and type of rooms. And in US dollar, they earn almost exactly the same amount of profit after tax. And yet, when we look at the enterprise value of both businesses, which combines their market cap and net debt outstanding, Vinpearl trades on 6 times the valuation that Southern Sun trades on, which I find quite striking.
2025 was really a fantastic year for many EMs and frontier markets. But I'm starting to see that uncertainty and fear creep into 2026 again. Now, we often see capital flows reversing very quickly during these risk-off periods. How indiscriminate are these outflows in practice, and what does it mean for pricing and fundamentally sound companies, Varshan?
So generally, when there's outflows, selling is quite broad-based, and we've seen it in a number of frontier markets such as Vietnam and the Philippines. And generally, there's a handful of large liquid stocks in each of these markets. And those are the first ones to get bid up when flows come into the market, and the first ones to get bid down when it reverses. And when there is large outflows of a market, what it can mean is that there's fundamentally sound companies which are growing their earnings year after year, but continue to see no positive share price reaction. So for us, that's actually a positive thing because we get to buy into these good companies at lower valuations. And there are some proactive management teams that take advantage of this by buying back their shares. So an example from the portfolio is a company called Alliance Global. It's a conglomerate in the Philippines, which we own, that has a number of listed subsidiaries as well. And they actually do buybacks at the subsidiary level and at the holdco level. So long-term investors are benefiting twice from the uplift in value per share.
Very interesting. You spoke about the Philippines, and I read something that one of you wrote on business process outsourcing in the Philippines being impacted by artificial intelligence. So this is also a big theme that we're seeing. I mean, we're talking about geopolitical noise and noisy markets. When we talk about fundamental shifts, we can't ignore the elephant in the room, and that's AI. Rory, to your mind, what is the current and potential impact of AI on frontier companies?
It's extremely difficult to say. But I think what is important to also highlight is certain business models are far more at risk of disruption than other business models. And so AI is very much at the moment, at least from what I can tell, focused on software, white-collar jobs perhaps like yours and mine are at far greater risk than if you're involved in manufacturing or trade. And one of the interesting things as well is when you look at a number of these frontier markets, they can also embrace these technologies. So depending on the level of education, and often you can leapfrog your comparative peers in developed markets because you don't have a lot of the legacy elements that you otherwise would. So if you take financial services and financial inclusion as an example, a lot of the neobanks in these markets where there isn't a kind of a high level of already financial penetration and there aren't 4, 5 or 6 really big, old, dominant banks, most of even if they're large and big, they're relatively young. They don't have this huge legacy system that they now have to kind of shift and maintain. And so they've been able to implement and embrace maybe not AI, but other kind of fintech things far more rapidly than their comparative peers in developed markets. And so you can actually have them deploying and releasing financial services, be it to your mobile phone or internet banking, at a much higher quality and a much lower cost than what you would otherwise see in the developed markets. And so it actually can be a benefit or a tailwind to a number of these businesses. And then other examples are, I mean, if you look at the Vietnam, for example, there's a population of 100 million people. The formalization of retail, in particular grocery retail, is still relatively low. I think it's around 15 or 16%. Wet markets still dominate. A wet market is which you would go every day, and you would have a kind of number of informal traders selling fresh fruit and vegetables, fresh meat and produce. And so there's a couple of businesses we've invested in Vietnam, notably Masan Group and Mobile World Group, which are two of the people trying to kind of deploy and win the modernization, formalization of grocery retail in Vietnam. Now, they might utilize AI for some pricing elements, and they may use AI for supply chain logistics, but I'd be extremely surprised, broadly speaking, if AI is going to displace in its entirety the need to go buy and find food. And so here are two businesses that I think can actually benefit just from the formalization of retail, irrespective of what happens with AI. And if they're successful, these could be, with the fullness of time, really kind of big businesses, and you're not paying a high multiple today for that potential opportunity.
So a disruptor that has the potential to benefit these businesses.
Well, I'm not sure if they're a disruptor. I think the risk of disruption in their businesses from AI is extremely low.
When I think about valuations, there's a great saying that a valuation is a number times a story. And what's that basically saying is a valuation is an earnings number times a price earnings multiple, for example, or a net asset value times a price to book multiple. And when I look at the risk of AI, we're not seeing much change, for example, currently in the number, which is the PAT or the net asset value, the NAV, which is basically the balance sheet value of the business. But we are seeing big moves in the ratings or the story element. So I think part of our job is trying to work out where is that story change justified and where is it overdone. So as Rory said, for example, there are some IT implementation businesses in Pakistan or Vietnam, for example, where we think there's a great risk of AI disruption and we don't own those stocks. Whereas in our portfolio, about 14% is in basic materials, about 25% is in consumer staples. Those stocks we think have a very low risk of AI disruption, but many of them have derated to a large extent. So we are seeing opportunity from the AI risk as well.
So you mentioned the metrics, which are fascinating. We talk about them all day. So it's kind of how we speak to each other. But if I were to tell the story to an investor who's probably never heard of the Frontier Fund and is saying it's a story, how would you talk about those metrics?
So a price to earnings ratio is basically a multiple of earnings. So if a business earns 100 Rand a year and it trades at 1,000 Rand, it's on a price to earnings multiple of 10. And a price to book ratio is the price you pay for a business relative to the assets it owns. So if it has a net asset value of 1,000 Rand and you're paying 500 Rand for it, you're getting it at half of book value, which is generally a good valuation level to buy in at.
Because what we're looking ultimately is for our undervalued assets.
That's right. And then, I guess when you're comparing assets across geographies, so if you looked at the MSCI World Index as an example, the average company in the MSCI World Index trades at around 21 or 22 times historic earnings, so last year's earnings. Mm-hmm. Across the emerging market universe, the average business trades at around 14 or 15 times earnings. So, broadly speaking, a 20-30% discount versus the MSCI World Index. Then the average small emerging market or frontier stock at this point in time trades probably at around 12 to 14 times earnings. So even bigger discount. And then if you look at our fund overall, now remember, we don't have to buy the entire index. We're just looking for 30 to 40 high quality names across a basket of north of 4,000 shares that we're paying on average around 8.5, 9 times earnings at this point in time. So now there's no guarantee that these are as good a quality business as all of the businesses in the MSCI World Index, but you're getting them at a more than 50% discount. And actually, given the level of research, we actually think a number of these businesses are better quality businesses, more defensive, more likely to grow over the longer term. And so there is kind of where the question again comes down to, yes, there's a big emphasis on the risks, but on the other side of the equation, am I being adequately compensated for taking these risks, or are these risks disproportionately priced? And in our case, we think yes is the obvious answer. Like, you're being more than adequately compensated to take this risk. And in fact, you're getting a great opportunity to buy overlooked, unloved companies at bargain bin prices.
I don't like bargain bin. I like to think about it as good value for money. I mean, at that valuation, it's the portfolio across the board. It's quite compelling.
If you were going to go to the local library sale and somebody has inadvertently put a Hermes Birkin bag there.
You're speaking
so
my
you're getting
language.
that high quality at that low price.
I love it. But, you touched on the fund looking quite different to the index. And I was looking at it and I see we currently have overweights to Nigeria, Georgia, and Kazakhstan. And you've got underweights in Romania, Vietnam, and Latin America. What's so interesting is that in 2025, the fund managed to outperform the benchmark, but had a very different makeup. So your Peru, your Vietnam, Colombia, Romania, they delivered more than 60% returns. You had some overweights to some poor performers. How did you manage to still outperform the benchmark?
So I think maybe if we take a step back and we just talk about how we construct the portfolio, is we're completely benchmark agnostic, we're completely geography agnostic. We start with the universe of around 4,000 plus shares, and we do some very high-level screening to kind of whittle that down to a more manageable screening size of, let's say, between 300 and 400 shares. And we use a variety of ways to screen that. We look at how much have they grown over the last few years? Have their share prices fallen precipitously over the last few years? How much cash do they have on their balance sheet? What are their margins like? What are their returns on equity like? So how capital intensive are these businesses? Once we've got it down to a basket of around 300 or 400 shares, we do a bit more high-level analysis to identify what we think are maybe 50 or 60 or 70 potential opportunities. And from there, we would again whittle that down to even a fewer number, and where we would write what we call policy group reports, where we do kind of fundamental, deep-level research, where we would allocate it to an analyst, and they would spend anything between 2 and 6 months really kind of trying to understand this business as best as they possibly can. And so over time, we've got analysis of probably north of 100 shares now, fundamental, deep-level analysis, that we thought already at that point in time when we started the research that optically it looked quite attractive. And we build the portfolio from the bottom up. So you're finding businesses that you think are trading at a big discount to our estimate of intrinsic value, and you're slowly acquiring and buying their shares. And in any one country, when we're looking at a company within that country, we look at the fundamentals of that business, and then we look at how the macro may impact that business. So how much of their earnings are in local currency, how much are in foreign currency. If for whatever reason the economy slows down or speeds up, what impact does that have on that local business? So we do factor in the macro element. But broadly speaking, we're looking for high quality businesses across geographies, and then we build the portfolio from the bottom up, and then and then at the end you end up with we may have some exposure in Colombia, we may not have any exposure in Colombia, as it happened last year. We may be overweight the Philippines, we may be overweight Nigeria, but that's more an outcome than a deliberate top-down view. And because we're only trying to identify 30 or 40 companies as opposed to the entire index, there can be many instances where you happen to find the 2 or 3 companies in that country that do extremely well, even though if you had to take a basket of 50 or 60 or 70 companies in that country, broadly speaking, they haven't done well. And so what you'll find over time is our performance is likely to be very different from the benchmark.
So looking under every rock for the diamond.
Well, looking under as many rocks as we can. So one of the other things is because the universe is just actually so large, is there's going to be plenty of diamonds out there that we're just not aware of, that also are exceptional shares that we just don't see, or it's too difficult for us to understand and we're going to miss it. But that's also okay, because there's more than enough diamonds to go around.
I mean, you've got 100 shares that you've done a deep dive on across geographies, across sectors and industries, and the universe is just about to get larger. So Varshan, my question is, there's been a recent expansion in the investable universe. What has been the rationale for this, and which countries are included?
The rationale is by casting a wider net, we have more opportunities to look at and more regions to access, as well as the opportunity to invest in new industries that weren't available in our existing country set. So an example would be airport operating companies, or companies which have their own proprietary IT systems or software. And another benefit is by including these new countries, the investable size has increased by 10 times or so. So over the long term, we have much more scope for growth in the fund. And we're also able to invest in much more liquid shares. So it's much easier to get in and out of those businesses. And alpha is an evolving concept over time, and it moves to different industries and different places of the world. So by expanding our investment universe, we will be able to follow alpha to more places in the future.
Alpha is an outperformance above the benchmark.
You find that outperformance in different countries and different industries over time. So you could get a situation where currently, for example, we have about 16 or 17% of the fund in Georgia and a similar amount in Kazakhstan, which are great places to invest in currently. But that could completely change in 5 or 10 years' time. And alpha opportunities could be in countries that are outside of our current universe. So by expanding the universe, it gives us much more scope to take advantage of those shifts over time. And in terms of the countries that we are including in the universe, so there's 15 in total. In South America, we have Chile and Mexico. In Europe, we have the Czech Republic, Greece, Hungary, Poland, and Turkey. In the Middle East, we're adding Kuwait, Qatar, Saudi Arabia, and the UAE. In Asia, we have Indonesia, Malaysia, and Thailand. And South Africa is also in the expanded universe, but I don't envisage us investing in South African shares in the Frontier Fund, as many of our investors already have large exposure to our South African funds. So we don't want to double up on South African exposure in the Frontier Fund.
So there's a consideration of what it would mean for our local investors aiming to use Frontier Fund as a diversifying element to their overall portfolio.
When we launched the fund, our focus was on frontier, but the distinction between what is a developed market, what is an emerging market, what is a frontier market, it focuses on, the level of economic and market development, the liquidity, the size of the investable universe, how friendly they are to foreign investors, but it is what's somewhat subjective.
The line shifts between
exactly that. And so what we found is that, in particular, when we had this previously constrained universe, is the largest countries in our universe were always predisposed to being upgraded to small emerging market. And conversely, the small emerging market countries were at risk of being downgraded to frontier. So in any one year, you might have one or two countries leaving your index and one or two new countries entering your index, which introduces quite a lot of disruption for us and confusion for the potential investor. And so we took a step back and we looked at the overall universe and we said, well, broadly speaking, if you had to kind of highlight or identify a larger basket of small emerging and frontier markets, what would that look like? And then just to add one or two additional numbers, so with this expanded universe, the reason we think it still very much focuses on small emerging and frontier markets is collectively, all of these countries make up roughly 2% of the MSCI World Index. And even if you exclude all of the developed market countries and you focus just on the broader emerging market index, overwhelmingly that is dominated by the large emerging market countries. That's China, Brazil, India, Taiwan, Korea, and historically Russia. And if you that makes up around 82%. So really our focus is on around 18% of emerging market countries and all of the kind of frontier and beyond frontier countries that aren't even in any recognized global benchmark. But where the opportunity comes is that's north of 4 billion people on this planet. So roughly 50% of the population represented by 2% of the investable universe.
So very asymmetric. What's so fascinating is something you taught me about how interesting that distinction between frontier and emerging and developed markets can be is Iceland is a frontier market. Fascinating.
Or Greece is a small emerging market,
okay,
but it's about to be re-upgraded to developed market status.
And that's just because things that have happened in their history that has delegated them to frontier status.
Yes. Unfortunately, what you find with the people that create these benchmarks, a lot like rating agencies, they tend to focus overwhelmingly on the past as opposed to the future. So rating agencies are very good at telling you when someone or a company is already bankrupt. They're less good at saying, in 3 years' time, there's a bigger risk here. They wait for that person to basically default and then they go, whoopsie, now we're downgrading the rating on this. And the same is true for the companies that do the rating. So if you took Nigeria as an example, which we have a decent exposure to, but just from an index inclusion or exclusion perspective, so it was in the frontier markets universe. And then during COVID, they fixed their currency to the US dollar. So basically imposed capital controls. Mm-hmm. And by virtue of fixing your currency, you disrupt the natural flow of currency in and out of the country. And it becomes very difficult for an investor to get in or out of the country. And they kept their currency fixed right up until early 2024. Over that same period in time, MSCI was reviewing this and came to the decision towards the end of 2023 that they were going to remove Nigeria from most of the indices as a result of these capital controls, with effect, I think it was February 2024. At the same time, the government introduced reforms to liberalize the currency and move to a market-determined rate. So at the exact time where you eliminated the reason for excluding them from the indices is the time that the MSCI indices chose to exclude Nigeria from their indices. And to further compound matters, the Naira goes from 800 Naira to the dollar to roughly 1,500 Naira to the dollar. So significant currency weakening. Many of the shares in Nigeria, fall 40, 50% in that month. You're forced to crystallize that if you choose to follow the benchmark. If you did what we do, which is kind of be benchmark agnostic, and you look at it after the fact and you say, well, here was a situation where there was pent-up demand to get out of the country. A lot of that has overnight left the country. It's caused the currency to almost halve. It's caused the share prices in dollars of a number of companies to similarly halve. Is there an opportunity here? At that point in time, you could pick up the banks in Nigeria at 2 times earnings after this devaluation. And if you did your kind of research and your work, you could actually look at the balance sheets of these banks and you would say, well, actually, they look pretty well insulated or hedged versus this currency devaluation. Particularly the larger, higher quality banks, something like Zenith Bank or Guarantee Bank, had 40, 50% of their loan book and deposits in US dollars. So, after this, you could have bought the banks at 2 times earnings. And fast forward to today, they've actually grown earnings in US dollars. And the banks have re-rated to 4 or 5 times earnings. So still very cheap in comparison to global peers. But you've kind of had a doubling of your money on the re-rating alone. And the currency is kind of stabilized at around $1,400 to the Naira.
So very helpful to have been benchmark agnostic. But you touched on something quite important. We can't chat about investing in frontier and emerging markets without touching on currency. So, we discussed frontier and EM markets as well as the currencies had quite a strong renaissance in 2025. And a lot of that was driven by a weaker US dollar. Now, we chatted a little bit about Nigeria and the Naira. How do you think about currency when investing in some of these markets, Varshan?
That's a very key concern, and it's something that's always top of mind. So our fund is measured in dollars, and to compare companies in different regions, we first have to look at everything in dollars. So one of the key questions is the local currency over or undervalued versus the dollar? And that's a very hard question to answer. It's much easier to say when a currency is extremely cheap or extremely expensive, but for most of the time, it's sort of roughly fairly valued. And another thing that we notice with currencies is that there's a very high level of persistency. So good currencies tend to continue to be good, and bad currencies tend to continue to be bad. So if you're investing in a company in Ghana or in Argentina, for example, the base case would be to assume you're going to lose a lot of the local currency return to currency depreciation. And when we look at the companies at the individual level, we also look for mismatches. So you don't want to have a company where all of the revenue is in local currency and the vast majority of their OPEX and CAPEX is denominated in US dollars.
So the expenses.
The expenses, yes. Over time, if their currency is going to weaken against the dollar, you're going to get their margins decreasing over time. And another common pitfall in frontier and emerging markets is to get US dollar debt, because the interest rate on a US dollar debt may be 4 or 5%, for example, whereas the interest rate on a local currency debt might be 10, 15, or 20%. And lots of companies look at the lower rate and think it's more attractive. But over time, the currency depreciation against the dollar more than offsets that. So we try to find companies that don't have big mismatches in terms of their revenue and expenses or in their funding in terms of local currency versus US dollar.
So thinking about it like a very prudent businessman.
Yes, all wise investing is good business.
Now, you're speaking about mismatches. And for me, I always think about disconnect when I think about mismatches. And we've spoken about markets being fearful and uncertain. And when something like this is elevated, there's a definite disconnect between the fundamentals we focus so much on and prices. So this is an opportune time for opportunities. So Rory, at the moment, which regions, countries or sectors are beginning to stand out for valuation-driven long-term investors like us right now?
I would say most emerging markets, broadly speaking, look very attractive relative to history. But maybe if I can flip it and ask you an example and see if you would invest in this country.
Go for it.
So there's a country, it's got extreme wealth, but alongside that, there's extreme poverty. So inequality in this country is very high. Across a number of the cities in this country that you and I would probably consider world-class cities, there's widespread poverty, there's drug addiction on the streets. It is a democracy, although the political situation is extremely polarized. There's allegations and concerns raised about voter suppression and wealthy people trying to influence the outcome of the election. The current president has had multiple cases raised against him. There's allegations of corruption and family enrichment leveled against him. Gun violence in this country is a daily reality. It's got one of the highest per capita rates of gun murder. Incarceration in this country on a per capita basis is also extremely high relative to peers. On the positive side, the economy is growing, but the government, I would argue, is being fiscally irresponsible. They've been running a budget deficit for several years in a growing economy. Debt to GDP is well over 100%, so you could say it's maybe unsustainable. And then the currency has been broadly stable, strong during periods of time. More recently, I'd say over the last year or two, it's been quite weak. But within this country, regardless of the economic and political reality, you can find a number of high-quality businesses that many of which earn a significant proportion of their money offshore. So they're somewhat divorced from the day-to-day economic reality for the man on the street in this country. Does that sound like an investment opportunity for you, or do you think what I've described is maybe a little bit too risky?
So I know how your mind works, Rory, and what you're describing is the US.
That is correct.
But that is the reality. You would expect that to be sort of like an emerging market or frontier type country. And what you're describing is all completely true, but it's the US, and like 71% of the world's index sits in US stocks.
That's exactly right. And people are very comfortable taking those risks with US companies and US names because they're very familiar with those companies, and they draw comfort from the fact that almost every other investor in the world is also disproportionately invested in those companies. And so where does the opportunity for us come is, everything in life involves trade-offs. And so you can either draw comfort from the fact that you're investing alongside everyone else and you're investing in very familiar names, Apple, Microsoft, NVIDIA, Tesla, everyone knows about that. And then the secondary part of that equation is what price am I paying? And that might be uncomfortable. Conversely, you can go into a number of these emerging and frontier markets, and you can describe some of these political and economic risks, which are true across a number of emerging markets to a lesser or greater degree. And then I'll introduce some esoteric name or company that you've never heard of. And suddenly you start getting a little bit more uncomfortable because now these risks in your mind are elevated, even though these risks are probably true across most countries and geographies. And there's a feeling of discomfort because now there's these risks and this unfamiliar name. But what you don't look at is then, well, what price am I paying? And can I draw comfort from that? And so that's the trade-off in my mind, is you can either have the comfort of a familiar name or the comfort of a low price, but it's very rare that you can find both.
And it's the ultimate challenge for us as humans. We lean towards continuity, what's happened over the last decade and a half. We lean towards familiarity. It's so hard to consciously step out of that and check the bias. So I think in closing, I would like to pose this question to the both of you. You both think as contrarians, so it's unlikely we'll have the same response. I'll start with you, Varshan. If there's one misconception about frontier or smaller emerging markets that you think investors should challenge right now, what would it be?
Horatia, I think investors should reconsider their risk attitudes. So as Rory and yourself touched on, we are seeing increasing incidents of supply chain shocks and companies operating with a number of operational risks. And across many frontier nations, management teams have been living under these circumstances for decades. So they have much more experience with dealing with these sorts of challenges. And many of them have strong balance sheets and high insider ownership. So the percentage of the company that's owned by the management teams is quite high. And they place a premium on being robust. So the philosophy that they use to run their businesses could be described as a just-in-case philosophy as opposed to a just-in-time philosophy. So when we're moving into this world of higher inflation rates, higher conflict, higher uncertainty, why not bet on these companies that have decades of experience and a track record to back them up? And I think under these circumstances, the riskiness of frontier stocks is much less compared to developed markets than most investors perceive.
Okay, so reconsider risk attitudes from Varshan. Rory?
I'd like to choose the same answer, actually, and say...
Where's the contrarian thinking?
People need to reconsider their understanding of risk. So you want a free meal, but the reality of investing is you cannot avoid risk. And so really the question is, well, what risk am I taking? Because if you took an investment that's completely risk-free and you're able to eliminate all of the possible risks, you're probably going to overpay, in which case it's return-free. And so I think investors in frontier and emerging markets really need to reconsider how they approach risk and ask, am I being adequately compensated for the risks that I'm taking? And from our experience, we think the risk is disproportionately mispriced in these markets, which then creates the opportunity for contrarian fundamental analysts who can identify those mispricings. And so if I can leave the listener with one final thought, is I would say is, the more negative the news, the more negative the sentiment, the more bad things feel in the short term. Over the long term, that's what creates the opportunity to get outsized returns.
And on that wisdom, that brings us to the end of episode 34. My thanks to Rory and Varshan for sharing their fascinating insights into how fear, capital flows, and fundamentals are shaping frontier and emerging markets right now. Some of the key takeaways for me from listening were: when fear is elevated and prices disconnect from fundamentals, compelling opportunities surface. Frontier and emerging markets may have increased volatility, but over the long term provide valuable diversification for your overall portfolio. And as author Yuval Noah Harari once wrote, people are usually afraid of change because they fear the unknown. But the single greatest constant of history is that everything changes. In that vein, periods of heightened uncertainty often create uncomfortable headlines, but they can also give long-term investors the opportunity to look past sentiment and focus on fundamentals. If you would like to get in touch, please send an email to podcast@allengray.co.za. You can subscribe to this podcast on your favorite podcasting platform to be notified of new episodes. Lastly, Allen Gray is an authorized FSP. To view our terms and conditions, please visit allengray.co.za. Until next time, I'm Horatia Naidu McCarthy. This podcast was produced by Volume Podcasts.
Time. When you're a kid, it moves slower than a sloth trying to get through airport security. There is just so much of it. Skip forward a few years to your 20s. Time is still your friend. It says have some balance. Go party and have fun. Then your 30s hit. And time suddenly steps on the accelerator like it's trying to catch a traffic light before it goes red. 40s. Now time is moving faster than your 10-year-old on a sugar high. 50. You're desperately trying to save as much as you can, but time is moving so fast. And all you can think is, where did all the time go? That's why after 50 years of investing, we've learned that time is the greatest gift of all. And the good news is, if you invest early, time gives you money. And then money gives you more time for some much-deserved you time. Now, isn't that a compelling enough reason to invest? Allen Gray. Long-term investing. Allen Gray is an authorized FSP.